Cash seized as Evergrande faces a liquidity crisis. I'm your host, Steven Van Metre, and thanks for joining me today as Evergrande finds its bank accounts wiped out as the creditors come knocking, putting it on the verge of massive liquidity crisis threatening to tip the entire global real estate market into a massive crisis. Let's head over to Wall Street Journal, who headlines that Evergrande's hidden debt sinkhole just keeps growing, and that months after Chinese developer ran into trouble, new debts keep coming to light. Worryingly, the problem isn't Evergrande alone, and we've talked about that in the past when we were covering this. The Chinese developer said Tuesday that more than $2 billion of cash held by its separately listed property service unit has been seized by banks as security for third-party pledge guarantees. The subsidiary said it discovered this during preparation of its 2021 financial report because, for those times that you've got a couple $1 billion stashed away that you've totally forgotten about. Both Evergrande and the unit won't be able to meet the deadline to publish their annual results before the end of March. Evergrande Property Services, which generates fees from managing apartment complexes, was assumed to be a relatively solid business with recurring revenue and holding net cash. And that assumption turned out to be rather rosy. The cash seized by the banks comprises nearly all of the cash on its books, leaving Evergrande broke. The hidden debt problem probably isn't unique to Evergrande, as Kaiser, for example, surprised the market last year by saying it guaranteed some wealth management products. More similar incidents may come to light as auditors have now been clued into the problem. Evergrande says auditor has been a large number of additional procedures this year, blaming COVID-19. A number of other developers, such as Sunak and Ronshine, have also said they can't publish their audit results on time. And no doubt the reason is they've been cooking the books. And this is something that we learned during the great financial crisis, that books were being cooked by many different firms at different levels. And so when you get busted, or your buddy, in this case, some of these companies, Evergrande, their buddy gets busted, you've got to go redo your books. Because once the auditors figure out where you're cheating, well, the word gets around real quickly. And well, they come for you, and everyone knows it. And Evergrande, whose $22.7 billion worth of offshore debt is deemed to be in default, making that paltry $2 billion that was seized to be nothing to go to pay off that debt, is seeking to further enhance communications with creditors to meet its end of July target. In a sense, they're going to tell the creditors that you're probably not going to get paid, but someday we hope you will. And Evergrande, once China's top-selling developer and now reeling under more than $300 billion in liabilities, defaulted on some overseas bond payments in December and has struggled to repay suppliers and creditors and complete projects and homes. So it's not just people who've loaned Evergrande money that are in trouble here. It's people that are even working for them, have done work for them, that are not getting paid. So everybody is not getting paid. And on this news, as you probably won't be surprised to find out, that China Evergrande had to halt its trading in stocks just on this news on Monday. And as a Hong Kong listed property services and electric vehicle units were also suspended from trading. And why was that? Well, their shares have tumbled 89% in 2021, and they've only risen 3.8% so far this year. And so what you see is this fear of more bad news driving the stocks down and perhaps making Evergrande worth a whole big zero. Now, if you're concerned that this Evergrande situation could roll into another financial crisis, well, you shouldn't be. Be sure to check out Portfolio Shield. I'll put a link in the corner in the description below. You'll be glad you did, because what I'm about to explain to you is some pieces of why not only how it works, but what's going to happen in the bond market, which is just reeling from the news of the Fed and what is going to be one of the biggest policy mistakes in the history of the Federal Reserve. And I'm going to show you exactly what the Fed is doing, why it's the wrong move, and what is the absolute outcome here. And that will tie back to Evergrande, as Wall Street Journal headlines today that U.S. stocks rise after Powell says the Fed is ready to be more aggressive. Of course, stocks don't really understand that that's the wrong move. And the U.S. Treasury market, the sell-off, is now one of the worst since 2016. The government bonds have intensified selling, sending the yield on 10-year Treasury note climbing. Again, on Monday, the yield benchmark note is now around its highest level since May of 2019, before the COVID pandemic upended financial markets. Now, keep in mind, for those who remember, in late 2018, well before the pandemic, when you saw this rise in interest rates then, went on to be one of the biggest rallies in the bond market, and yields went crumbling down. Now, what's going on here is we are facing a massive dollar shortage, and this is impacting Evergrande. Now, let's go back to some of the concepts we talked about last week with the yield curve, and let's add on to what we learned so you can see just how bad the situation is and why companies like Evergrande, who are facing problems, aren't going to get out of the situation like we've seen in the past. So here is the 5/10s yield curve, which is a 10-year treasury minus the 5-year. When you see it inverted and below this black line, that implies there is a shortage in dollars in the market. Now, what you're seeing with these inversions is that 5-year yields are higher than 10-year. Now, why would that happen? Well, the banking system is short dollars. The financial system is short dollars. So what happens is rates go up, and what does that incentivize people to do? Put money into the banking system. And so that, as money comes in, then rates come back down. So what we're seeing in the financial system is, hey, we're short dollars. And note that that headline we just saw from the Wall Street Journal says that investors are throwing their cash into stocks. Of course, we've shown last week that when the yield curve inverts, it's actually very bearish for the equity market because growth expectations go down. And well, as we fall into earnings season here pretty soon for the first quarter, we should find out the projections for later this year aren't going to be that great. But now let me show you where the Fed is making a huge policy mistake, because what you'll note now is the federal funds rate is this, from the Fed's perspective, they're going to increase it. Now, I want you to note that every instance where you have an inverted yield curve, you see where I've circled the blue, the same spot, what happens is the Fed is actually lowering interest rates each and every time they're doing it. This time, they're raising rates. Now, why do they lower rates? Well, the Fed can't actually solve a dollar shortage, but what they can do is bring rates down, because who can actually create dollars? That's right, the banking system, when a new loan is originated. Now, of course, the Fed can't make the banks lend, no surprise, but what they can do is lower interest rates, because when the curve is inverted, what do banks do? Well, they tend to not want to lend. And when we overlay loans and leases and bank credits on a year-over-year rate of change, so this is going to be slower because it's year over year, no surprise, when you see a curve inverted and you see short-term yields at parity or below long-term yields, banks don't want to lend. And now we start to understand what the bigger issue is with Evergrande here. And so lending goes down. And when lending goes down, what happens to new dollar creation? It goes down. And so in a sense, the Fed's only move is to lower rates and hope people borrow to get us out of these tight financial conditions. But this time, the Fed says, no, inflation's a problem. We're not going to do that. We're going to tighten conditions even more. And what that means is things are going to break. And that's what happens when you tighten into a dollar shortage, is things break. In fact, in the past, when the Fed eased into these conditions, things broke anyways. So you remember the great financial crisis. The Fed had started easing already, and then things went really bad. So here we have a situation where the Fed's going to tighten into this, and that's going to be horrible. Now let's take a look at what that means for the bond market, because when you start to pull all this together and starts to make sense, why do rates come down? Because if rates don't come down, well, then guess what? You don't get new dollar creation, and then the whole system just collapses in on itself due to a dollar shortage. And that's why you see here on this chart, every time there's an inversion, of course, the Fed also eventually comes back to the rescue. You see interest rates go down, go down, go down, go down, go down. And you can guess now, when we're looking at the long bond, the 30-year treasury is here in red, why the probabilities that it's going to zero are so high. So how does this come all the way now back full circle to Evergrande? So think about it. They're in dire straits right now. They're in big trouble. They need cash, but they have cash flow. So what would they want to do is go to the bank or go to their creditors and restructure those loans. And what do the banks want to do right now with all that? They don't want to give them any money. That's the key. Because the curve is inverted, banks are not going to want to lend. So when things break, or when a company or maybe an individual household goes to the bank and needs money because they're short dollars, they're not going to be able to get it. And that's why things always break. That's why you see interest rates collapse. And that's why Evergrande is going to be the beginning of what are going to be more stories of companies running out of dollars and needing a major bailout, and this time, the Fed's not going to be there. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provides educational information only. It's not intended to provide investor advice. This share has to be construed as a recommendation or solicitation by or selling a security, financial instrument, or participate in a particular trading strategy. This video is spread by Steve Van Metre, personal capacity. Opinions expressed in this video that do not affect the value of Atlas Financial Inc. or Steven Van Metre Financial.